So outside of investing, one of my other hobbies is collecting watches, and in the watch collecting world, there's this idea of your holy grail watch. This is basically like your dream watch, and for whatever reason, it's unattainable in the moment, like maybe it's hard to find or it's just out of your price range or something. But nonetheless, this is the one that you look at and say, you know, if I could someday own this watch and add it to the collection, my life would be complete. And every watch collector has their grail watch. Usually they have multiple grail watches. For example, one of mine is the Tudor Black Bay 54. I just love the vintage and timeless look of this watch, and the size of it is perfect for my wrist, and it's one that you can wear pretty much in any situation. And guys, I know we're not here to talk about watches, but I bring this up because I feel like there are a lot of similarities between collecting watches and building a stock portfolio. If you think about it, like people who are into watches, investors are also collectors. After all, what is your portfolio if it's not a collection of stocks? And as the curator of your portfolio, your job is to build out your collection of holdings to the best of your abilities based on your own personal tastes, your investing goals, your life experiences, and your beliefs about the companies you own. And in the same way that watch collectors have their grail watches, investors also have their grail stocks and definitely have more than one of them. So in this video, I want to share with you some of mine. We'll take a look at one grail stock that I actually own, another one that I don't, and this other one has just been teasing me for years now. I cannot wait to buy this stock. And then we'll take a look at a third stock that I'm just now kind of starting to sink my teeth into, but I think it has potential to become another grail stock. But before we get into those, guys, I want to hear from you. Leave me a comment below and let me know, what are some of your grail stocks? I'd be curious to hear about them. So out of the three grail stocks we're talking about today, this is the only one that I actually own, and Visa is hands down one of my favorite companies in existence, and I think it's like the gold standard of stocks. First and foremost, out of all the different payment networks out there between Visa, MasterCard, Amex, etc., Visa is the top dog by a long shot, and as time goes on, digital payments will become even more common than they already are, and people will continue to use cash less and less, and the sheer size of Visa's network is a huge competitive advantage that I think will continue to serve them over the years. As more merchants, banks, and consumers join the Visa network, which is pretty much just a financial toll booth, the value of that network increases, which creates a flywheel effect where a larger network attracts even more participants, which then reinforces Visa's dominance in the space. And because a lot of the costs associated with maintaining Visa's network are fixed costs, that means that the more transactions they process, the lower the average cost per transaction, which allows Visa at this point to basically print money, and that definitely shows up in their financials, which are like perfect. And on that note, guys, taking a closer look at Visa's financials starting here on the income statement, we can see that all of the charts are pretty much going straight up and to the right. Sales have been growing over the last decade, gross profits have been growing over the last decade, and if we scroll down all the way to the bottom, we can see that this trend continues here in the net income in the bottom line. That's going straight up into the right as well. Now, not only is that happening on an absolute basis, but because of those fixed costs that we mentioned earlier, Visa is able to become more profitable over time. Now, as it was, Visa was already an extremely profitable company. We can see that 10 years ago, the gross profit margins were at 96%, but even so, in the last decade, they've managed to increase those margins as well. And now in the trailing 12 months, their gross profit margins are about 98%. So they've increased where they can. And if we scroll down, looking at the operating margin, we can see that that's also increased over the last 10 years, going from about 64% to now about 67.25%. So a little bit of improvement there. And looking at the bottom line, the net income margin, this has also increased, going from about 43%, which in itself is a very impressive net income margin, but this has climbed all the way to 54%. So that's all looking really good. Now, jumping over to the balance sheet, looking at Visa's debt situation, it's pretty negligible. I mean, 10 years ago, they had negative debt on a net basis, but now in the trailing 12 months, or rather as of their last report, their net debt is only about $2.9 billion, which as we can see is easily covered by their free cash flow. In the trailing 12 months, Visa's brought in almost $16 billion of free cash flow. And looking at the free cash flow chart there, just like everything else we've seen, it's going straight up and to the right. Now, like I said a few moments ago, in my mind, Visa is like the gold standard of stocks, and everything that we saw in the financials is pretty much why. It's hard to find a company with the financial strength that Visa has, and because of that, I think Visa has all the makings to be a really great dividend growth stock for a long period of time. And on that note, taking a look at Visa's dividend stats, probably the least exciting thing about this company is the dividend yield. It's not even 1%. It's 0.75% starting out, but everything else looks really good. They have a low payout ratio at about 21%, so plenty of room to pay and continue growing that dividend. No surprise to see based on what we looked at in the financials, but the 5-year growth rate, in my opinion, makes up for that low starting yield at 16%, and they also have a 15-year dividend growth streak, so they're pretty committed to growing this dividend. Now, like I said earlier, out of the 3 GRAIL stocks that we're talking about today, Visa is the only one that I actually own, and it's actually one of my larger holdings. If we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. Here we can see I have 20.4 shares of Visa at an average cost that's pretty in line with the current share price. It's just a little bit above the current share price, which means that I'm seeing a little bit of a loss. I'm down 0.6% looking at the share price returns. Dividends help me out a little bit, but not too much. On a total return basis, I'm only down 0.4%. And like I said, this is one of my larger holdings, currently making up about 8.8% of my portfolio's total weighting. So my next GRAIL stock, which is Rollins, has been teasing me for so long now, guys. I first started talking about this stock maybe a couple or possibly even a few years ago at this point. I don't remember exactly when it was, but when Rollins first came onto my radar, I know it was priced somewhere in the mid to low $30 per share range, which as we can see, it is clearly not anymore. And for me with Rollins, the time just has never been right. Anytime I've wanted to buy it, it's either been too expensive or like the few opportunities that I have had to buy it at a good price, I didn't take advantage of them. For example, last October, it saw a really nice pullback and got down to the low 30s, but for some reason, I didn't end up pulling the trigger on it, and truth be told, I'm not sure why I didn't. I think that was quite the missed opportunity. I've talked about Rollins quite a bit on the channel over these last couple of years, so I'm sorry if you've heard some of this stuff before, and I'm sorry if I'm repeating myself. I just think there's so much to like about this company. And while pest control is certainly not the sexiest or the most exciting business, it's very stable and it's one of those things that will always be needed. There are always critters that will find their way into places they shouldn't. And so pest control companies like Rollins tend to have a steady demand regardless of what's going on in the economy. And whether it's residential or commercial clients, people won't delay taking care of a pest control problem and definitely consider the removal of things like ants, spiders, and termites a necessary expense. And as we can see, because of this demand, Rollins has managed to increase their sales even during difficult periods like the Great Financial Crisis and when all of the COVID stuff was going on. I think that's a huge green flag. And another one is the amount of recurring revenue this company generates. At this point in time, 75% of their revenue is recurring, which definitely adds some predictability to the company and helps result in what overall I think is a really financially strong company. Jumping over to the income statement, just looking at how everything's trending, this is going to be pretty similar to what we saw with Visa. I mean, sales and profits are clearly growing on an absolute basis, but the margins are growing as well. 10 years ago, the gross profit margin was about 50%, which in itself is really good. Now it's a little bit above that, 52.3%. And if we look at the operating margin, that's gone from about 15.5% to almost 20%. So a bit more growth there. And as we continue down the income statement, the net income margin, the bottom line, has grown from 9.75% to now about 14%. And then just like with Visa, Rollins is a free cash flow printing machine. That type of chart right there is exactly what you want to see. Pull that up a little bit larger so you guys can really see it. Yeah, that's looking good. And obviously, guys, a growing amount of free cash flow is exactly what we dividend investors want to see because the dividend is paid out of the free cash flow. So if that's growing, then it's more likely that the dividend growth will continue, and that's certainly the case for Rollins. Now, as far as the starting yield goes, this is a little bit higher than what we saw with Visa. This is coming in at 1.25%, and the 5-year growth rate is actually higher as well, at 17% compared to Visa's about 16%. But I'm not going to stick my nose up at either one of those. These are both really solid 5-year growth rates, but Rollins' dividend growth history is definitely not as long at 3 consecutive years. But if we go over to the dividend history page, we can see that they have been making consecutive payments for the last 3 decades, almost 3.5 decades now. So that's good. Now, as far as adding this GRAIL stock to my portfolio, I'm not holding out for the low 30s again with Rollins. I'd be happy adding to this company somewhere in the low 40s, I'd say now at this point. Like if I saw the share price get to about $42 per share, I'd heavily consider starting a position. And then if, it went down from there after I initiated a position and was continuing to buy, if it went down from there, I'd be happy. It'd be a good opportunity to average down, but we'll see what happens. Now guys, I'm still in the early stages of doing my due diligence on this company, but I'm really starting to like LVMH, and I could see this potentially becoming another one of my GRAIL stocks. LVMH owns some of the world's most iconic luxury brands, many of which have been around for hundreds of years at this point, so the staying power is definitely there, and in general, luxury goods can be more resilient than other discretionary goods because an affluent customer base won't be as impacted by economic downturns. And also because they purposefully target people who have more money to spend, or at least want to give off the impression that they do, LVMH's brands don't have to offer deals or discounts on their products. In fact, doing so would be detrimental to the brands because it would dilute the luxuriousness of the brand image. But anyway, in addition to all of this, LVMH is extremely diversified, not only in terms of the different brands that they own, but also because of the different segments they operate in. And they're also very well diversified in where their sales come from. We can see it's a pretty solid mix around the world. And just like the other two companies we've talked about so far, LVMH's financials are looking great. Over here on the income statement, this is going to look pretty identical to the first two companies that we looked at. Obviously, the sales are growing for LVMH, the gross profits are growing as well. We're seeing a little bit of margin expansion over here in the gross profits, going from about 65% 10 years ago to now close to 69% in the trailing 12 months. So that is good. And if we scroll down looking at the operating margin, definitely have seen some expansion here, going from 18.5% 10 years ago to now 26.5% in the trailing 12 months. So an added 10% there. That's really nice. And then if we scroll down once more looking at the net income margin, I mean, 10 years ago it was about 18.4%, but then for the years following, it looks like it really dipped off there into the low teens, even around 10%. But now these days, guys, it's looking about 17.6%. So maybe all in all, there's been some expansion there. And looking at the cash flow, this has been growing as well. I mean, it looks like these last couple of years, it's seen a bit of a dip from 21 to 2023. It did go down, but overall, we're still seeing a generally positive trend. So that's a good sign. And then looking at the dividend stats, LVMH is going to have the highest yield out of the three companies that we've looked at so far at 2.1%. And the 5-year growth rate's right in line with everything else we've seen. This is coming in at 16.6%. And like Rollins, they've been growing the dividend for the last 3 years. And LVMH is actually looking pretty dang discounted right now, which I'm telling you more about in this next video right over here. In this one, we'll take a closer look at LVMH along with two other deeply discounted dividend stocks that both look like great pickups right now in July. So click right over here to learn about those, and I'll see you in the next one.